Welcome to the Debt Doctor podcast, where we deliver the definitive prescription for navigating distressed real estate debt. I'm your host and America's most qualified debt doctor, Bill Bymel. I've spent my career investing in, diagnosing, and reviving thousands of distressed real estate situations. The Debt Doctor prescribes proprietary remedies to help you identify, acquire, and monetize undervalued real estate assets. Each episode gives you insider access to the strategies top cohorts use to transform market volatility into double-digit returns. If you enjoy what you hear today, hit the follow button, subscribe so you don't miss an episode, and please share your support with a quick review. You can find me on the web at billbymel.com. Thanks for joining this episode of The Debt Doctor. Good morning, good afternoon, and good evening. My name is Bill Bymel, and I'm the Debt Doctor. I buy non-performing, sub-performing mortgages, first liens on real estate, commercial, and residential all across the United States. And I've been doing this for almost 2 decades now. So I've seen all kinds of situations, whether you're a banker, a borrower, a private equity investor, or just a cohort to the industry. This podcast is meant to really share insights and details about financial markets, credit markets, real estate values, the future of our industry. We have amazing conversations with all types of leading experts in the industry. Today, I'm talking to you from one of my private equity partners' offices in Park Avenue in New York City. Here I am sitting high and mighty above the world that controls New York real estate, and I'm honored to be able to say that my partner is a great group to work with. And the reason I want to talk to you for just a few minutes here is to talk a little bit about the state of the markets today. As I record this here in the summer, late June of 2025, there is obvious volatility in the geopolitical world. There's been a massive amount of stock market volatility just since the beginning of the year. And it's a very interesting path because everyone you speak to, whether it's the head of Chase Bank, Jamie Dimon, or the leading managers of debt markets at places like bond companies like DoubleLine, you hear warnings and hey, look out for red flags. The markets are going to quake. That there is overpriced assets across the board, and yet there are times where it just doesn't feel like the markets in general are responding to the warnings of some of this industry's most astute veterans. Take New York City, for example. Here I am looking down Park Avenue at Grand Central and the Chrysler building there and the MetLife building. And this is some of the most expensive real estate per square foot in the world. And it's really the greatest city in the world. And it will always be one of the greatest cities in the world. And yet New York has its own set of issues that it's gone through. Before COVID, in 2019, there was a law passed here in New York, which it was meant to help tenants by increasing or locking in place certain rent stabilization, rent control provisions. But it's also had the unintended consequence of starving inventory for affordable housing. The scale of the value destruction that's happened in New York, either pre-COVID and post-COVID, is really truly massive. New York City multifamily real estate prices have experienced significant declines since 2019, since a year before COVID came in and really destroyed industry for a period of a few years here. Some reports indicate that there was a drop of as much as 67% for rent regulated buildings in New York City in the last 6 years. This decline is attributed to a combination of factors, including this 2019 law that was passed called the Housing Stability and Tenant Protection Act. If you don't know what that's about, read into it some more. It obviously was intended to help people that were being forced out or bought out of rent controlled properties that developers were trying to convert to normal market, but it's actually had some reverse effects. The other aspect that attributes the combination of factors that's really having this negative impact on multifamily real estate in New York is rising interest rates. In the last 3 years, we've seen the cost of capital go from practically zero to a normalized market of 4 to 5% on the treasury rates, which translates to what most would agree is a normalized interest rate market in mortgages of the 6, 7, 8% range for a credit. Of course, there's also increased operating costs. There's nothing you can do about inflation. There's nothing you can do about 100-year-old buildings that are not environmentally efficient, that need to be repaired, that capital needs to be put into, the cost of insuring these buildings, the cost of electricity. Most leases involve some sort of gross rent as opposed to triple net rents. Since that New York legislature passed the 2019 rent control law, the supply of rental apartments in New York City has actually fallen tremendously. The reason for this is that landlords have literally taken these older, unrenovated units off the market completely. The New York City Housing Authority, their portfolio has reportedly has more than 5,000 empty apartments, a number of which have just sitting there vacant without any hope of being repaired and marketed. And this is because the cost of operating these 500,000 city-owned rental properties is really just become too staggering for the city to handle. Today, the city of New York is one of the world's largest slumlords, unfortunately, with the NYCHA tenants paying below the cost of operating buildings. This means that the 500,000 NYC property units are poorly maintained. They have little value in the private market. We've done some stats on it, and the annual operating cost for a private landlord for a single one-bedroom apartment in New York City is approximately $3,400 per month. Rent for a studio inside of a NYCHA property is averaging about $1,150 a month, and a two-bedroom averages just under $1,400 a month. So that means a private owner who is subject to rental stabilization or rental restrictions has really no chance of making any money. In fact, losing money every month. Whereas if they could take that rent stabilized unit and turn it into a private market rental, the average rent for a one bedroom in New York City is about $5,000 a month. You could actually make a little profit. So I know family after family who has literally chosen to leave their buildings empty and just pay the basic maintenance to keep the building intact. They're losing less money than if they actually had tenants and provided shelter. This is just a fact of what it is. And so if you were where this has come into the headlines in our debt market is, remember, about 2 years ago, the failure of two major banks that no one ever saw coming: Signature Bank and the New York Community Bank. These two banks were the largest lenders to the multifamily New York market. So when interest rates rose and the prospect of increasing delinquencies rose, combined with that 2019 law that really just put a hamper on any ability for any of these landlords to get out. Those portfolios started to tremendously decline in value. And those two banks went out of business 2 years ago. Both of them were bought by one bank. They now all fall under the name Flagstar Bank. Flagstar Bank, which 2 years ago was a $30 billion bank, increased to a $90 billion bank when it acquired New York Community Bank, and then again to a $120 billion bank when it took over the remaining left unsold assets of Signature Bank. So this bank has quadrupled in size, primarily taking on assets of multifamily real estate, some of which we've now proven could be down as much as 70% in value. This is just one example of the dislocation that exists in debt markets today. It's a proof that a long run of free money and low interest rates, combined with maybe some bad decision making on the political level, could really have an impact on private sectors in the near term. So keep an eye out on this space. More to be said. In the meantime, thanks for joining me. That's a wrap of today's episode of Debt Doctor. I enjoy bringing this content to you each and every week, and I really appreciate you tuning in. Remember to follow us so you get notified whenever new episodes release. If you haven't already done so, please share one of your favorite episodes with a friend, family, or colleagues. And if you don't mind, leave us a positive review on Apple, Spotify, or whatever your favorite listening platform might be. Until next time, thank you for investing your time with us on The Debt Doctor.